Okay, let's get into the stock market technical analysis. We're going to look at, I want to look at the broad markets. We'll look at triple Qs, a couple individual trade ideas, and then we'll wrap up. Please hit that thumbs up button. I do appreciate it if you're finding value, and let's get right into it. Triple Qs. All right, so bigger picture, we still have this bearish rising wedge here. It's been we've had a lot of reactions to define that wedge. We've got, over the last couple of days, we've started to kind of break to the upside of that wedge. To me, usually what happens when I see this kind of price action, when you have a bearish rising wedge with negative divergence that's been building and they break it to the upside, it's usually stop rate price action, all right? Which is typically, because it's a bearish pattern, people are expecting it to break down. So they'll break it up, break it to the upside, run a bunch of stops, and then it'll break down. So if that's true, if this is a stop rate, then I think we're likely to see that downside price action after the Fed. Maybe not initially after. We might kind of, move around a little bit, but I think, basically after the Fed on Thursday and Friday, maybe we'll see that downward price action. So I'll be looking for that. No guarantees we get it, but that would be consistent with that being a stop rate. Run the stops and then, roll it over. If we get that, the widest part of the wedge, which is really down here, would be the projected target. So depending on when we break, if we break down in the near future, then we're projecting that will be down around 460, 450 or so. Probably the 200-day moving average would be a good target because that'll likely come in just before, and you should see some buyers step in. So I'm projecting that if we get that price action to the downside after the Fed, we're going to have a drop of about roughly 12% down to the 200-day moving average in the triple Qs. Okay, so that's that. And then if you look at the SPY, S&P 500, we also have kind of this bearish rising wedge here. That one broke already and has been back testing. You can see it broke here and then back tested there and kind of back tested again. Basically drifting sideways right now. It looks like the sell signal is in, but it's probably not going to completely break down right ahead of the Fed. It's likely going to do it after. So it looks like we're just kind of floating up here, waiting for the Fed. And yeah, the projected target on this one, you did technically break it back here on October 23rd. And the widest part of the wedge does project that we head down around here, about 543-ish, or the 200-day moving average. And from where we're at right now, that would be a drop in the S&P 500 of about, down to the 200 is about 9%, and down to that 543-ish is about 10%. So 9 to 10% correction, it looks like is likely in the S&P 500, with about a 12 to 13% correction in the tech-heavy triple Qs. Now, obviously, that's calling for something that hasn't happened yet, so it may not happen. So we just kind of have to kind of watch the price action over the next couple days. The big player, though, is NVIDIA. This is your AI. This is the king of AI, basically. And on NVIDIA, as far as I can tell, when I look at the daily chart, this goes all the way back to when this rally really started in October of 2022. You've got reaction, a couple quite through there, but there's another defined reaction. There's another one. And we have clearly broken down and taken out that trend line. Now, obviously, the Fed has the power to recover this trend line. If they want to ramp this thing up and recover it, and this is just a false breakdown ahead of the Fed, then that's possible. But as of right now, it is a breakdown. So until proven otherwise, this looks like looks like we got a sell signal a couple days ago, and you can see it's broke here, but then they recovered it the next day, and then this day they didn't recover, and then 2 days ago, pretty clear bearish engulfing rejection candle. So I'd say your sell signal, your clean sell signal is right there, back on December 13th. Okay, so we should head lower, and down to the 200 would be the next stop. We have, Nvidia hasn't actually tagged the 200 since all the way back here in January of 2023. So, more than a year's worth, almost 2 years worth of time, Nvidia hasn't even touched the 200-day moving average. So that's where I think we're likely headed, and then you should see some buyers step in. The algos will kick in to buy Nvidia at the 200. So I would very much expect a bounce. If we don't get a bounce, something else is going on. This is Tesla. Tesla's just kind of pumping. I wouldn't touch it, at least on a short side of things. I don't think I'd go long either. It's pretty much gone parabolic, so it should likely crash down once the momentum dries up. But as of right now, I don't see any signs that momentum is finished. So nothing really going on with that. Google, they ramped it yesterday, but today does look like it's putting in a shooting star doji, some sort of doji right there, reversal candlestick. What you want to do to confirm is you want to look for continued downward price action, a confirmation candle. So we want to see more selling tomorrow, and that likely would happen after the Fed. So probably gonna just kind of grind around in the morning, and then we'll see where it goes after the Fed. Energy. So XLE is our energy sector. Looks like we're getting close to some support. You can see it's pretty much been a straight down ride. But on the daily chart, we've got a trend line to watch. There's some support right there. Really oversold too. If I look at this XLE, we haven't been this oversold since COVID in the energy sector. So here's one thing that to me looks kind of interesting is the fact that if the economy is so strong, why are we not seeing the energy stocks really participate in the rally? In general, they're just being sold into. Typically, with a strong economy, you're going to have more demand for energy, and we're not seeing that reflected in the energy stocks. So again, it really just goes back to most of the rally has been contributed to just a handful of tech stocks, and it's basically like the AI bubble. They just keep kind of pumping AI news in different stocks. This week was really AVGO. That was a big, there's your AI pump. Selling it into right now, but again, so that's kind of what's going on. It's just more continuation of the AI mania. But again, the king of AI, as far as I can tell, Nvidia, starting to break down. So the rest will follow. If this continues to break down, the rest of the AI stocks will follow, and then they'll slap some headline on in terms of maybe it's not profitable or who knows. Okay, let's go into some individual trade ideas. Shorts, we've got GE. This one hit the 200-day moving average. So we did get that drop down to the 200, and it's not really going anywhere. It actually looks like it's kind of bear flagging, likely waiting for the Fed. And if it is bear flagging, you've got a flag pull here, then you flag out, and then you do a continuation of that. And that would set us up for a move down to about 152-ish on GE. So I could just probably move my line down to about there. And yeah, I like that as a level, capturing those reaction lows right there. So again, we would need to see impulsive selling, but if we get it, then this bear flag should move us down to that projected target. So something to look for there. Abercrombie and Fitch, ANF, continues an isometrical triangle. This is a compression pattern, and it's an indecision pattern. So you can see all the reactions on the upside, all of them on the downside. No real divergences. We just have kind of compressing momentum as well. So there's no real clue in terms of which way it's going to go. But typically what you do is you just take the break whichever way as the next trend. So break to the upside would be bullish. Break to the downside would be bearish. And that is, that's what's going on. So we'll just wait and watch on that one. FITB, talked about this one for a while, especially in the private member group. Link in the description below if you're interested in joining that. Big bearish rising wedge, all right? So that's obvious. Big negative divergence, indicating we're likely going to break down. One little whipsaw breakdown there on the this was right ahead of the election. They pumped it on the election right into resistance, but it's now officially broken down. We had the sell signal really back here on December 11th, I think, was a good official sell signal, and it continues lower. So you can see today down another 1.84%, and looks like we're heading down, continuing lower. The major target on this one is the widest part of the wedge. So that's here, and I've just got this blue line kind of marking out the major target. So I've got us going down to about 34.30 or potentially down to this 32 level for the projected target. So that is a drop. Even the more shallow target, if we get down to there, that's a drop of about 23%. And this one's just started. So you can see continuing down, looks good. Nothing wrong with that trade. Okay, so interest rates, TNX. This is your 10-year interest rate. Very important chart. Probably one of the most important charts to watch as we head into the Fed. And we need to watch how this reacts after the Fed. So the Fed's obviously expected to cut interest rates by a quarter point tomorrow. It's priced in, and they will do that. If they don't do that, obviously look for the markets to crash. But for the most part, it's priced in. They're going to do it. They don't surprise. So quarter point hike or quarter point cut tomorrow. What does the bond market do with that? Because the Fed is cutting, they're easing, and if you own long dated bonds like 10 years, 20 years, things like that, essentially the Fed's creating more inflation, and that's going to inflate some of the value of your bonds. So does the market, are they okay with that or not? This is your interest rate, and you can see we're basically trending lower in yields, and we're right now right at resistance, and there's a reaction. You can see they're reacting to it today. So this is likely not going to break out before the Fed, but it could after. There is some bullish divergence here, but we did get a decent rally up into that resistance. So at this point, there's no real clues on the momentum indicators telling me if it's going to break out after the Fed. So we just have to watch it. This is resistance as of right now. So until that is proven otherwise, then, it's objective to short basically or go long on like TLT. You can't short the TNX. This is just the interest rates. But if you go over to the TLT, it's basically the inverse chart. Probably have to kind of dial that in a little bit, but you can, this doesn't quite look the same, but it's basically like that. I have to just adjust the trend line, and that shows that TLT is at support. Now, I personally wouldn't be interested in taking a position that's, so interest rate sensitive right ahead of the Fed, but you could look for, reaction after the Fed and see what this wants to do. Philip Morris, this is a trade idea. We broke down. So on Philip Morris, you had a clear uptrend line, several reactions, negative divergence was building and building. And the sell signal basically came right there, and it's heading lower. So projected target is, I would say the 200-day moving average is a good target. So it's consistent with what it looks like the SPY is going to do. Looks like we're going to have a correction in the broad markets as well as, some of these individual stocks. This looks like a objective long CF. It's at support basically today. So you can see lots of reactions on this trend line, and we're there again today. So it's at support. Now it does have negative divergence. It's got it right there in the momentum indicators. That's a divergent high. So, we could break that trend line, or maybe there's another leg up. Divergence doesn't tell you to short. It just tells you that, the trend is going to end sooner than later. But it doesn't mean we can't get another leg higher, and this divergence can build and build for a while. So it's at support. It does have negative divergence though, so something to take note of. And I think that's all I got for right now. So I'll get the video out, and we'll see how the market reacts after the Fed tomorrow. Okay.